Tom Essaye is the founder of the Sevens Report, joining us. A short notice today, Tom. Appreciate you jumping in. Good to see you. Let's talk about what's happening in government bonds, because as Ben and I were just discussing, it looks like they're at a bit of a juncture here to determine if we're in this downtrend from September or just still in this epic rally that's been going on for years. Where do you fall on the subject?
Yeah, I think we are at an important crossing the roads here. And, first of all, Oliver, thank you very much for having me on. Always love coming on. And look, what you guys were talking about in the last segment is really true. We are getting a diverging signal from stocks versus bonds. And all I'll ask people to do is look back to the last two bear markets we've had. You look back at 1998, and you look back at 2000, and then even 2007 as well. Bonds ultimately told the story over the medium and longer term. So I think we really have to pay attention to what's going on with the 10-year.
Okay, so the case that I was making was, if we look in the last couple of years, 2018, it seemed like maybe not the S&P 500 from the benchmark level was a perfect, crystal ball, but the cyclical names were a great insight that the synchronized growth story was kind of bunk. Chips, home builders got slammed. Yep. Then as they turn around, right as the yield curve's inverting, it's like they kind of had better insight than bonds again. So how will we sort of be assessing this if the bond market, indeed, the sort of structure of it has changed and is more volatile?
I think that's certainly something we have to consider, definitely. But if we stretch out, and I think it's an absolutely great insight, that equities have become a better gauge than they used to be. But at the same time, bond yields are still going to tell us about the global market's expectations for growth and for inflation. And the bottom line is, if we're going to see a global reflation, then the 10-year yield has got to get above 2%.
Right.
I mean, this would be like the weirdest thing in history, that we're going to have a booming global economy, yet the 10-year yield won't go above 2%. So I think that's an important level for people to watch. You get the 10-year yield above that level, I think that's a pretty good all clear, especially over the medium longer term.
So here's what the chart we're looking at right now over the long term, right? Obviously, what we've seen has been this sharp move as the bond had rallied back this year, 2019. The question then is, what's the follow through? Because some of the selling, maybe one could just attribute to stabilization. I think it's a good point that you make, is, the re-acceleration is a different story. And so far, does it, is the data telling us about a story of acceleration?
Yep. No, not yet. And we have to remember so first of all, this is a very seasonally strong period for stocks. Everybody has huge gains. Nobody wants to sell right now and realize a whole bunch of gains for tax consequences. So equities have a tailwind. The bigger issue, though, is U.S.-China trade. Markets have rallied ahead of a U.S.-China trade deal based on the assumption that that will reignite global growth. But what if it doesn't?
Right.
What if the phase one deal is a nothing and we don't get a global reflation? I'm not saying it's going to happen. I'm just saying nobody's considering that right now, which makes me a little bit nervous.
I'm glad you bring it up, Tom, because we have been. And I think it's the most important point, right? Is there a snapback to earnings that have been revised lower? Is there a snapback to GDP, which has been revised lower on the trade scenario? Is there compelling evidence for this?
No, there isn't compelling evidence that the global economy is going to reflate as of right now. I mean, even look at the Chinese data from last week. It was universally disappointing. The manufacturing data before that, sure, it wasn't as bad as it was in September, but it wasn't good either. It's still contracting. So we've got to wait for the data to come in. Look, this is a market that's rallied on hope. And guess what? There's probably going to be a trade deal, and there probably will be some tariff rollbacks, because it's in everyone's best interests for that to happen. But it's not a done deal, and we just need to, listen, markets aren't priced for perfection, but they are priced for a very good outcome, and it's close to the end of the year. I just want people to be aware of that.
Tom, the power of technical analysis, some would argue, I don't know how big of a chart guy you are, but the idea of being able to kind of gauge, relative conviction through price, I think is at least telling us the last couple months that even though the acceleration may be a fairy tale, the stabilization is enough for bonds to sell a little bit compared to the deep fear that kind of paralyzed the market, for bonds and gold in the spring and summer. So is there a level on the 10-year where we start to become more convinced about strength in the economy, that maybe the chart will kind of tell us what's coming?
Yes, absolutely. And I do definitely follow charts. I'm more of a fundamentalist, but I definitely follow charts. I love when the two agree. 2% in the 10-year yield. Your point is 100% correct. The 10-year yield at sub 150 was ridiculous. That's pricing in like a global depression. That wasn't going to happen. We're probably fairly priced now. If we can get the 10-year yield above 2%, it's a nice round number, easy to watch. That's a good sign that the reflation is actually starting to take hold and people are believing it.
Let's talk about Jay Powell. FOMC comes out this afternoon. This used to be one of the, for the last 9 months, probably one of the most important factors for the equity market, as we saw cuts help valuations. Cuts change the kind of landscape here in a big way. Now that those are on hold, do we expect volatility around this event, Tom? What are you looking for?
Yeah, I don't think this is going to be much of an event. And listen, I've read so many Fed minutes in my life, make my eyes bleed. But I don't think that this is going to be much of anything because the Fed has been very clear about what their policy is going to be. A year ago, the Fed messaging was terrible. It's become much improved now. And we all know that unless we get the economy to roll over, which would be very bad, or inflation to take off, which is extremely unlikely, then the Fed's on hold for the foreseeable future. I don't think the minutes are going to change that view. I think the bar to get the Fed to move one way or the other is incredibly high, as high as it's been in multiple years. So, the minutes will garner some attention. Maybe the algos will trade off of it, based on some of the words in there, but I don't expect it to impact markets beyond the next couple minutes after it comes out.
Tom, with all this said, equities continue to just plug away to new highs, the NASDAQ in particular. Is there then a potential shift back towards some of the growthier parts of this market? That's been the case now for basically the month of November after they got beat up real hard. Software is now back to its highest price of the year, and the NASDAQ's leading. What do you think about this?
Yeah, I think that there is. I've kind of been kind of negative on the whole rotation from growth to value beyond the short term for the simple reason of this. Most of value ETFs are extremely overweight energy and financials. In order for energy and financials to go up, you have to have higher yields and better global growth. Well, if we have better global growth, I'd rather own growth stocks. So I think that value can outperform in a little bit, as it has been, but this over the longer term, I don't think this lasts simply because of the makeup of value ETFs. So yes, I'm still a believer in growth, especially if this market continues to run.
We've also got this tension that continues to build in Hong Kong, the U.S. now weighing in as well. It's hard not to think about this through the lens, in an almost kind of selfish way here about the trade discussion that's happening. But is this a wild card now? Because, even if trade doesn't have the ability, a deal to, snap back growth, I don't think it can possibly hurt, right? It's definitely going to be helping CEOs make decisions, which could at least give some degree of comeback. So how big is the geopolitical problems that are happening in China?
Clearly, a very tragic events going on in Hong Kong. From a trade standpoint, I think I'm an outlier here. I don't think that this is that big of an influence on the trade talks, simply because both sides need a deal, right? They need a deal. The Chinese economy is weak. We are facing, risks, headwinds on this economy. They both need a deal. Hong Kong is separate. The resolution of the Senate will not help things. I don't think it derails the phase one, though.
Yeah. All right, Tom, really great stuff as always. Good analysis. We got to run, Mr. Essaye. Thank you, sir.